It's Brian Preston, the money guy.
FinWiz91 has a question for you. This is the first year my company is offering the Mega Backdoor Roth, and my plan is to use my bonus to mostly fund the excess space. Any considerations I should be aware of, given this is all new to me?
All right, considerations. Brian, why don't I talk a little bit about what the Mega Backdoor Roth is for folks who aren't familiar with that? So here in a nutshell is what the Mega Backdoor Roth is. It means that you work with an employer that when you go to look at your 401k contributions, not only can you do pre-tax contributions, and not only can you do Roth contributions, but there's a third contribution type called after-tax contributions. And it's exactly what it sounds like. You put the money into that bucket, but it's after you've paid tax on it. Well, a lot of people don't realize the salary deferral limit, the $22,500, only applies to the pre-tax bucket and the Roth bucket. It does not apply to the after-tax bucket. So for folks who are higher income or have the margin to be able to save, not only can they max out their salary deferrals, they can also start putting money into that after-tax bucket. Well, the way that it normally works is the money goes in after tax, it grows tax deferred, and then when you pull it out, you would pay taxes on the earnings, and then your contributions, your basis would come out tax-free. Unless you work with an employer that will allow in-service distributions. And one of the great planning opportunities you can do is you can fund the after-tax portion of the 401k, and then once a year, twice a year, depending on the cadence you do, you can then go request an in-service distribution, and you can roll that amount directly into your Roth IRA. So it's a way, instead of only being able to contribute $6,500 or $7,500 into a Roth IRA, you could actually contribute $30,000, $35,000 into your Roth IRA on an annual basis by using the Mega Backdoor.
And a lot of plans we've also noticed have started allowing in-plan conversions too.
Sure,
you don't even have to do the distribution out. They've actually started allowing in-plan conversions. That's a great way that makes it even easier. Here's the big thing to pay attention to, though, because FinWiz, you're like, what's the catch? This sounds great. I mean, because Roth is tax-free. I remember last time we did a show on this, there's a reason I was talking about apex predator status, because Roth assets just sit on top of the food chain because they're so great for legacy planning. They're so great for retirement. There's a reason the government restricts how much you can put in these tax-free growth accounts. But here's where the catch is. You've got to be careful that you don't crowd out the employer's money, because the government. You have your salary deferral for 2023. You can do $22,500 if you're 50 and over. It's $7,500 on top of that. But then, in addition to that, there's this background number. And Bo, we ought to get the team to give us one of those cool little laminated sheets I see that they keep. Yeah, because it's not 58. What's the actual number now?
I think it's 62,000 this year.
So there's limits that the government lets you put into these employer plans, but they make you group all of the contribution types, the salary deferrals, the employer match, the profit sharing, they all kind of get grouped in together. So if you're funding in $66,000. So if you're putting in $22,000, you can quickly see that leaves $44,000 for the employer to fund. You just want to be careful that you don't go put in a big chunk of money into this backdoor Roth, because guess what, the things are structured is if you put in enough money that it actually crowded out where your employer would exceed their contribution, would actually exceed that annual threshold limit, you just foregoed it. The employer gets like, hot diggity dog. I just didn't have to give that to that employee. So be careful of that. And then the other reality is pay attention to the three buckets. When I talk about three buckets, I'm talking about your tax-free accounts, your after-tax, like your brokerage accounts, whether it's individual or joint, that's just your after-tax investment account, and then your tax-deferred account. Because I've seen a lot of people, because you're getting through steps, because this really does fall into step 6 or 7 on the financial order of operations. I don't want you to be so cash poor, meaning you have no liquidity, that you have all these retirement accounts, but you actually can't afford to go pay cash for a car if you're trying to buy a nicer vehicle, or you have trouble with if you had a big medical expense, or I don't know. You just need to be careful that you still have access to liquidity. So pay attention to where the 3 buckets are for both your current life, but also your future life. Because we're planning not only for the future, we're planning for today. And that requires some balance and planning.
The only last thing that I'll throw on top of this, because we have a lot of clients who we help perform these transactions, they're not like the logistically most easy, smoothest transaction, because a lot of times what will happen is you'll call your 401k provider, you'll request the in-service distribution, but they can't just send out the basis. They'll have to send out your after-tax contributions plus any applicable earnings. Well, if you're truly trying to do this in the tax-free way, which is the way that we like to do it, then you have to think about multiple account movement. You have to send the earnings to one type of account, and then you have to send the after-tax portion to another type of account. And then if you're also perpetrating regular backdoor Roth contributions, then you got to move some money back into the 401k. So there's like a flow chart where it gets fairly complicated. If you're someone who's thinking about doing this, thinking about implementing this strategy, this may be an indication that you're at the point where it might make sense to take the relationship to the next level. Because we've done hundreds of these. We do these all the time. But if you don't know exactly what you're doing, or if you don't do it exactly right, you're going to get a 1099 at the end of the year showing some taxation that maybe you likely otherwise would not have wanted to pay if you could have avoided it.
Yeah, it's basically going to you trying to cut the ingrown toenail out versus hiring a podiatrist to do it. You need to. There's a reason that you want to make sure that when it gets to things, yeah, you could do it, but there's also a lot of ways you could screw it up. And we all need to be able to walk. So let's not, it's the same way we all need to be able to make sure our money flows right. Let's buy into somebody having some experience to know where all the traps or troubles and tricks are to make sure you navigate it well.